Hello everyone and welcome back to the world of finance. You are watching Finance Concepts with Nikhil, and in this session let us talk about an interesting concept titled as factoring. Before I step into what is factoring, let us first understand the current business scenario around us. If you are a supplier supplying some kind of goods or services, in today's business scenario, you have a need to provide credit to your customers. So if you are a firm selling goods, you have a need to make sales on credit. Making sales on credit or offering credit sales or offering some kind of credit terms to your customers has become your need today. So if making credit sale is your need, what is the problem? You are definitely going to encounter two problems. Problem number one, you have to take effort of making collection from your debtors because you have made sales on credit, and assume that you have given credit for 3 months. So during this period of 3 months, not all customers will promptly come and pay to you. You will have to put efforts, you will have to incur cost to collect this money. Not only that, during this span of 3 months of credit period, your money, your working capital gets blocked with these debtors or with these receivables. As a result, these two problems you would want to handle, and you would want to outsource the responsibility of making the collection. So what simply can be done? You can hire an agent who would make collection from your customers on your behalf. Obviously, this party will be charging certain amount of fee for making this collection for you, and this whole arrangement can be titled as a factoring arrangement. Let us first try to understand the whole arrangement in details. So what we find in front of us, there is a firm and there are its customers, and the firm makes credit sales to its customers. So now it has an obvious need for making collection from these customers. So for this purpose, the firm appoints an agent known as factor. And what is this factor going to do? This factor agrees to make collection on behalf of the firm for a fee, obviously, and this agent also agrees to provide advance to the firm. It also provides advance to the firm at an agreed interest rate. So now with this whole arrangement, the factor has agreed for making the collection and has also agreed to provide an advance. So if we go exactly in the sequence of events, so factor will first make an advance to the firm. So the problem that the firm was facing of blocking its money, that problem gets solved immediately. And now what happens? When the due date arrives, the factor will make collection from the customers. So now the factor has collected money from the customers, and now from this total amount collected, the factor will deduct its fees that it is supposed to charge. It will also deduct interest on the amount advanced to the firm, and obviously it will at the end deduct the amount advanced. The final balance of payment will then be remitted to the firm at the end. So friends, whatever you are finding on screen, that is nothing but the picturized version of what we call as factoring. Let us summarize what we have just discussed. Factoring is an arrangement where a firm appoints an agent known as factor who would collect the outstanding balances from the debtors of the firm against a fee. The factor may also advance money to the firm at an agreed interest rate and will earn interest on the amount advanced. Generally, the factor will maintain a margin or a reserve while advancing the money to the firm. Let me just explain this last point written over here. What is this reserve that we are talking about? Assume that the average balance of debtors is rupees 20 lakhs. So what do you think? If the factor has taken responsibility of making rupees 20 lakhs collected on behalf of the firm, when it comes to providing advance to the firm, is the factor going to advance all 20 lakhs? The answer is no. The factor knows that factor is going to earn some fees for this collection. Factor is also aware that factor is going to earn some interest on the money advanced, and more importantly, there may be some bad debts that might arise. So for all these reasons, the factor would maintain some reserve, some margin, and would not advance the entire balance of debtors to the firm, but only a part of it. So let us take an example that the average balance of debtors is rupees 20 lakhs and the factor has agreed to maintain a reserve of 20%. Maintaining a reserve of 20% would indirectly mean that the factor is providing an advance to the extent of 80% of average debtors balance. So you may compute it either way. You may take average balance of debtors 20 lakhs and subtract the reserve. The reserve is 20%. 20% of 20 lakhs would be 4 lakhs. You arrive at the net advance amount of rupees 16 lakhs. Or you may present it differently by directly taking 80% of average balance of debtors as the amount to be advanced. That will be 80% of 20 lakhs, that comes to rupees 16 lakhs. Let us now try to understand the types of factoring as non-recourse and recourse factoring. So these types of factoring, most students what they do is they try to memorize the meaning of recourse and non-recourse. Understanding the meaning of recourse and non-recourse is what is required. You try to memorize, you will tend to forget. So I don't want you to do that. Understand what is recourse and what is non-recourse. First of all, recourse. The word recourse indicates an alternate course of recovery, an alternate course of action, in simple words. So assume that I am the firm and I have appointed you as a factor to collect money from my debtors, and the arrangement is a recourse arrangement. So you come to me and ask me, sir, what would happen if the customer does not pay? That means what would happen if bad debt arises? I tell you, don't worry. If bad debt arises, I will handle it. I will handle my customers. You don't bother about it. That means I am giving that comfort to the factor that there is a recourse available. There is an alternate course available. If you cannot collect, don't worry, I will collect. Or if there is a bad debt arising, I will bear the loss. You don't worry about it. You just put best efforts for making the collection. Now this is called recourse factoring. So in recourse factoring, I am taking the burden of bad debts upon me. I am the firm. The firm bears the losses of bad debts when it comes to recourse factoring. Now what happens in a recourse factoring? The moment the factor is not given that responsibility of bad debts, the factor might become little casual in terms of making collection, and therefore bad debts, whatever level of bad debts would have arisen, there may be chances that the bad debt volume increases, the amount of bad debt further increases. Therefore, the arrangement can be made little differently, that I ask the factor, boss, you have been given responsibility of making collection. If you cannot make that collection, it is your problem. I am offering no alternate course. If I am offering no alternate course, that means there is no recourse. Non-recourse factoring would eventually put the burden of bad debts on the factor. That means now you can summarize it that recourse factoring, it is a firm that will bear the loss of bad debt, and if it is a non-recourse factoring, the factor itself will bear the loss of bad debts. So what we have just discussed, under a non-recourse factoring, any loss arising from bad debts will be borne by the factor. Under a recourse factoring, the bad debt losses are borne by the firm itself. Generally, the commission rate is higher in a non-recourse arrangement. Alright friends, let's get started with questions, and beginning from question number 1. Let us read this. The annual credit sales of X Limited were rupees 48 lakhs. The company offers 3 months credit to its customers. Currently, the bad debt losses are 2% of total credit sales. The company appoints a factor who would collect the receivables at a fees of 5% on a non-recourse basis. It is expected that administrative and collection cost of X Limited will be reduced by rupees 8,000 per month. The factor also agrees to advance to the company by charging interest of 15% per annum. The factor would maintain a reserve of 25% of the debtor's balance for providing such advance. Assume that interest and commission are paid to the factor at end of each cycle. Determine effective cost of factoring. Now, before we start solving the question, let us first understand how exactly we are going to approach. So, if you look into one thing, the overall credit sales of the company, it is given as rupees 48 lakhs in a year, and the company is giving 3 months credit. So, first of all, what you would do is, on an average, at any given point of time, what is the average balance of debtors you should find out. So, the idea is very simple. You are offering 3 months credit and your annual credit sales is 48 lakhs. So, we can simply conclude on an average the monthly sale will be rupees 4 lakhs, that is 48 lakhs divided by 12 months, it will be rupees 4 lakhs. Now, if monthly sale is rupees 4 lakh and 3 months sales you have given on credit basis, as a result, it will be 3 multiplied to 4 lakhs, that is rupees 12 lakh will be the average balance of debtors. In simple words, you can compute average balance of debtors by taking annual credit sales, that is 48 lakhs, multiplied by 3 by 12. 3 is the credit period and 12 indicates the number of months in a year. So, 48 lakhs into 3 by 12, that gives you 12 lakhs. It is the average balance of debtors. Now, if I am the company, I have appointed the factor. I have asked the factor to collect this 12 lakhs for me and to give me some advance. The factor is not going to give me entire 12 lakhs as advance. I have explained you this earlier. So, factor is going to maintain reserve of 25%. If the factor is going to maintain reserve of 25% on that 12 lakhs, that will be 3 lakh of reserve that the factor would maintain, and therefore the factor is willing to advance 75% of the average debtors balance, which comes to rupees 9 lakhs. On this advance, the factor will charge me the interest at the rate of 15% per annum, and for the collection effort, factor is going to separately charge a fees. Now, in the question what is given, the factoring is on a non-recourse basis. Some time back I have explained you what is the meaning of non-recourse basis. Non-recourse basis means the factor is going to bear the loss of bad debts. So, from my viewpoint, that is company's viewpoint, if this factoring arrangement is undertaken, there will be savings in bad debts and there will also be savings in the administrative and collection charges which the company is currently incurring on its own. So, friends, you would make two typical calculations. Number one, the amount advanced by the factor and interest thereon, and second calculation that you will make will be the overall net annual cost of factoring, and then we would express that cost of factoring as a percentage of the overall advance. So let us see how to present the solution. So in the solution, as I have just mentioned, you would first start with the calculation of amount advanced by the factor and interest thereon. So first of all, average balance of debtors 48 lakhs into 3 by 12, that will be rupees 12 lakhs, and the factor is maintaining a reserve of 25%. Indirectly we would say that the amount to be advanced will be 75% of average debtors balance, and that will be 9 lakhs. The rate of interest is 15% per annum. So annually the interest will be rupees 1,35,000. One thing that you should follow, that this is the overall annual interest calculation. So you may pause the video if you want to note down these calculations, and if you have written this already, let us move ahead. After making the calculation of amount advanced and the interest thereon, we would calculate the overall cost of factoring for the year. Now the factor fees, in the year the factor is overall going to make collection of 48 lakhs, right? So if you look into, one cycle is of 3 months, and in a year there will be 12 months. So in a year there will be 4 cycles. 4 times the factor would collect 12 lakhs for us, and in total the factor would collect the entire credit sales of the year, that is rupees 48 lakhs, and would charge 5% fees on this entire collection, which works out to rupees 2,40,000. Now interest charged by the factor we have already computed, 1,35,000. So your annual cost comes to 3,75,000, but there will be certain types of savings. So first of all, currently you are incurring bad debt losses of 2% on your entire credit sales, and that is working out to rupees 96,000. Because the factoring is on a non-recourse basis, this 96,000 of loss which you are currently incurring, you will start saving. Now we will also have savings in administrative and collection cost, that will be rupees 8,000 per month. For the entire year it comes to 96,000 again. So the total cost of factoring is 3,75,000, and there will be savings of 96,000 and 96,000, which is finally going to result into net annual cost of 1,83,000. And now we have to find out what is the effective cost of factoring. Effective cost of factoring will be net annual cost, that is 1,83,000, divided by the net amount advanced, that is 9 lakhs, into 100, that comes to 20.33% per annum. Friends, you may pause the video and write it down, and once you have finished writing, I'll have to provide an additional explanation. First write it down. Alright, if you have finished writing this whole thing, let me explain one important thing. Generally students have a typical doubt over here. They ask me, sir, this amount 1,83,000 is the annual cost, but this 9 lakh was not based on the annual credit sale. This 9 lakh was 75% of 12 lakhs, and 12 lakh is the amount to be collected in each cycle. So their general doubt is, this 9 lakh is calculation in terms of each cycle, whereas 1,83,000 is the total annual cost. Friends, understand one point. There will be not a single cycle in the entire year. There will be 4 cycles, as I have mentioned. So if you would want to make calculations for each cycle, you would take 9 lakh as the base, and all these calculations will not be as it is. Each calculation will be then taken 3 by 12, that is 1/4 of each of these. So your overall factoring cost will be just 1/4 of 1,83,000 for one cycle. That you will consider as numerator divided by 9 lakhs, and whatever you get will be the cost of factoring per cycle, and then you multiply by 4 cycles, you will eventually get the same thing. So one important point for you to understand that the base of calculation will always be the amount advanced by factor, and that will be a common base whether you are calculating factoring cost for the cycle or for the year. However, the numerator will change depending upon for what period you are computing the factoring cost. So if you would want to present the solution on an alternative basis, I will just show you calculations in terms of each cycle. So for each cycle, factor fees will be 5% of 12 lakhs. Interest charged by factor will also be proportionately computed for 3 months only. That is 9 lakh into 15% into 3 by 12. That comes to 33,750. The overall cost will be 93,750. Savings in bad debts for that one cycle will be 2% of 12 lakhs only. That is rupees 24,000. Savings in administrative cost will be for 3 months again. So 8,000 per month multiplied by 3, that also works out to rupees 24,000. So net cost per cycle will be rupees 45,750. So effective cost of factoring for each cycle of 3 months will be 45,750 divided by 9 lakhs into 100. That comes to 5.0833%. Look into one thing, the base remains 9 lakh, but because you have decided to compute the cost of factoring on a per cycle basis, the numerator has got changed. Now this is cost of each cycle, and there are 4 cycles in a year. When you multiply this to 4, what you will get is the annual cost of factoring. Let me show you even that. So the effective cost of factoring for the year will be 5.0833% multiplied by 4 cycles, and that comes to 20.33% per annum. So friends, we are not going to follow the per cycle calculation. This was just for you to understand this concept. Once you are clear with this, we will solve all the questions ahead with annual calculations only. Alright friends, let us move ahead and take up the next question, that is question number 2. And let us first read this. X Limited makes a sales of rupees 80 lakhs a year. Credit period offered to customers is 3 months. The company wants advance against its debtors and considers 2 different alternatives, that is bank financing and factor financing. Bank has offered to finance 80% of average debtors at interest of 15% per annum, whereas factor has offered to finance 80% of average debtors at interest of 12% per annum. Administrative cost relating to collection is rupees 10,000 per month. Presently, bad debts amount to 2% of total credit sales. As the factoring arrangement is on non-recourse basis, the company will be saving bad debts as well as the administrative cost if the financing is done through the factor. For the factoring arrangement, the factor will charge a fee of 5% on the targeted collection. Suggest which alternative will be better, bank financing or factor financing. Now what is something different in this question if we look into? Here we have 2 different ways in which we can raise funds. One is by factor financing and one is by bank financing. That means you can arrange the finance, arrange working capital loan kind of from the bank also. Now what will happen? Factor can bear the loss of bad debts. Bank is not going to come and bear your losses of bad debts, correct? Factor will make collection on behalf of you. Bank will not make any collection on behalf of you. So basically, we come across a situation where you have 2 different alternatives, and how would you approach this question? It can be done by 2 different methods. Number 1, you can make a comparative cost statement. That means what will happen if you go with bank financing and what will happen if you go with factor financing. Just make a comparative cost statement and decide which will be the cheaper mode of financing, bank or factor. That means the annual total cost, whichever is lower between bank financing and factor financing, will be preferred. The second approach could be the way we have computed the effective cost of factoring per annum. In the earlier question, you can make the calculation exactly the same way and then compare that with the rate of interest offered by bank. Comparing these two also, you can decide the same and the conclusion will always be same. So friends, what I am going to do on the screen, I am going to show both the approaches of solving question. If in examination the question is asking typically a particular method of approaching, you follow that. If not, you are free to use any approach, any method. So pay attention on the screen. Let us see how to present the solution. First of all, in the solution, we would compute the average balance of debtors. So it will be 80 lakhs as annual credit sales, 3 months credit offered. So it will be 80 lakhs into 3 by 12, that comes to rupees 20 lakhs. Amount advanced by bank or factor will just be 80% of the average debtors balance. So that will be 80% of 20 lakhs, which works out to rupees 16 lakhs. For deciding which alternative will be better, the calculations can be made by two different methods. So friends, you may pause the video if you would want to write up this, and if you have written this already, let us move ahead. So now we go with the first method, that is comparative cost statement, and we have two different alternatives, bank financing and factor financing. Interest charged by factor will be at the rate of 12%. So factor is charging interest at 12%. 12% of what amount? 12% of 16 lakhs, that works out to 1,92,000, and bank is going to charge interest at 15% on 16 lakhs, because both bank and factor are providing the same amount of advance, that is 16 lakhs. Bank is charging a higher rate of interest, that will be 2,40,000, that is at 15%. Now factor fees is at 5% of total annual credit sales, so it is 5% of 80 lakhs, that will be 4 lakhs. Bad debts will not arise when it is factor financing. Bad debt will arise only when it is bank financing. In simple words, if you are seeking finance from bank, your bad debt losses at 2% of annual credit sales, that is 2% of 80 lakhs, which works out to 1,60,000, will arise only and only when you are arranging the finance from bank. In factor financing, it does not come for one big reason, because the factoring is on a non-recourse basis. Administrative cost. Now within factor financing, this administrative cost won't come, for simple reason, because you are already paying this 5% fees to the factor, correct? And factor is going to make collections for you. This kind of administrative cost you will not incur over here in this alternative of factor financing, but you continue to incur that cost when it is bank financing. So now once we have plot down all the costs, we can simply take the total annual cost comes to 5,20,000 and 5,92,000. We can now conclude that the total annual cost in bank financing alternative is lower than the total annual cost under factor financing. So the conclusion is very simple, that is the company should accept the alternative of bank financing. In simple words, bank financing would be cheaper than factor financing. So friends, you may pause the video if you have yet to write it. If you have finished writing it, let us move ahead. Now in the second method of approaching this question, we will be using the effective cost of factoring concept, what we have learnt earlier. So we would first make calculation of total annual cost on the net basis for the alternative of factor financing, and here factor fees would be rupees 4 lakhs, that is 5% of 80 lakhs. We would now consider the interest charged by factor, that is 12% of 16 lakhs, and that works out to annual cost of 5,92,000. You will subtract the savings in bad debts, that is 1,60,000. You will also subtract savings in administrative and collection cost, that is 1,20,000, 10,000 per month into 12 months, and finally the net annual cost comes to 3,12,000. Friends, you may pause the video if you have yet to write this. If you have already finished writing this, let us move ahead. So, once you get the net annual cost, you can find out the annual effective cost of factoring, that is 19.5%. Now friends, what is the significance of this calculation? This is the annual effective cost of factoring, and now you may simply compare this with the interest charged by bank. Bank's interest rate is 15%. Now 19.5% is definitely higher than 15%. So you may simply conclude that the effective cost of factoring is higher than the rate of interest charged by bank. The company should prefer the alternative of bank financing. Friends, you can always pause the video and write the content before we move ahead. If you have already written everything, let us move ahead and write down some important notes now. If the question uses the language like the factor agrees to buy the receivables of the firm, or the firm sells its receivable to the factor. Notice the language of the question. The factor is buying the receivables of the firm, or the firm is selling its receivable to the factor. Buying and selling means what? The risk and rewards attached to the ownership of that asset is transferred, right? That means the risk and rewards attached with the debtors is being transferred to the factor. So then it is implied that all risk and rewards associated with the receivables have been transferred to the factor. This implies that the factoring is on non-recourse basis. So as I have always been instructing, pause the video, write down these important points and then move ahead. Alright, so next important point. Generally in a factoring arrangement, the factor might recover fees and interest upfront, that is at the beginning of the arrangement. In such case, the factor will reduce the amount to be advanced by such upfront fees and interest. Sometimes there may be an offer of advance by bank, and the firm has to decide whether to accept the arrangement offered by factor or the advance offered by bank. This last paragraph of note we have just seen in the previous question, right? And that kind of question you can approach by two different methods, that is by comparative cost statement and by computing the annual effective cost of factoring. Alright friends, let us move ahead and look into the next question, that is question number 3. Let us read what is given over here. Annual credit sales of A Limited, all on credit, is rupees 1 crore 32 lakhs. The company offers 2 months credit to its customers. Currently, bad debts are 1.5% of total credit sales. The cost of collection incurred by the company is rupees 20,000 per month. The company is thinking of appointing a factor who would make collections from the debtors of the company by charging 4% fees. The factor is also willing to advance 80% of the receivables at interest rate of 18% per annum. You are required to determine the effective annual cost of factoring under following cases. Case 1. Interest and fees are charged by the factor at end of each cycle, and interest and fees are charged by the factor at the beginning of each cycle. That means you have to now approach this question in two different scenarios, when the factor is charging the fees and interest at end of each cycle, and then case 2 at the beginning of each cycle. So let us see how to present this solution. Over here, first case, interest and fees are charged by factor at end of each cycle. First of all, you would compute the average debtors balance, and that will be 2 by 12 of 1 crore 32 lakhs, that is 22 lakhs. So amount advanced by factor will be 80% of this, that is rupees 17 lakh 60,000. Friends, I have been instructing you that any point of time you want to write down the content, you may pause the video and do that. So keep following that same instruction ahead also. Let us move ahead and look into the cost of factoring for the year. factor fees will be 1 crore 32 lakhs into 4%. Interest charged by factor will be 18% of 17 lakh 60,000, and the total cost comes to 8 lakh 44,800. Then the savings in bad debts will be 1.5% of 1 crore 32 lakhs, that is 1 lakh 98,000. Savings in administration and collection cost will be rupees 20,000 per month into 12, that will be 2 lakh 40,000. And finally what we have is net annual cost of 4 lakh 6,800, and the annual effective cost of factoring would come to 23.11%. Now this is under the situation where the factor is collecting the interest and fees by end of each cycle. So friends, you may pause the video, note down the whole thing. If you are done writing the whole thing, let us move ahead. Case 2. Interest and fees are charged by the factor upfront, that means at beginning of each cycle. So average balance of debtors we have already computed, it was what? 22 lakhs. Now what we do is, amount eligible for advance will be 80% of 22 lakhs, that is 17 lakh 60,000. This time the factor is collecting the fees for that cycle at the beginning of that cycle itself. That means it will be 4% of 22 lakhs which will be collected at the beginning. Because it is collected at the beginning, the amount of advance gets reduced. That means the amount which is eligible for advance gets reduced by 88,000. The amount now is 16 lakh 72,000. So the interest will now be computed on this amount. So upfront interest will be 16 lakh 72,000 into 18% into 2 by 12. Because the interest is also collected upfront, interest for the entire year cannot be collected upfront. So interest for only that cycle will be collected upfront. So finally the net amount advanced comes to 16 lakh 21,840. So you may pause the video, note down the calculations, and if you are done writing this, let us move ahead. So in this case again, the cost of factoring for the year will first be computed. Factor fees remain same, 1 crore 32 lakhs into 4%, 5 lakh 28,000. Interest charged by factor this time changes a bit because of the amount advanced getting reduced. Okay, so your annual cost comes to 8,28,960. Now there will be certain savings. So savings in bad debts will be same as we have computed earlier, and savings in administrative and collection cost will also be same as we have computed earlier. So the net annual cost reduces a bit, but when you compute the annual effective cost of factoring, understand one thing, the denominator over here will be further reduced because of that upfront interest. You have computed this already in the earlier working, that is the net amount actually advanced by the factor. And what happens finally, because these collections are made upfront, the cost of factoring increases slightly. It was 23.11% earlier, now it is 24.11%. So you may pause the video, note down the calculations, and if you are done writing this whole thing, let us move ahead. Question number 4. A Limited has total sales of rupees 3.2 crores and its average collection period is 90 days. The past experience indicates that bad debt losses are 1.5% on sales. The expenditure incurred by firm in administering its receivables collections efforts are rupees 5 lakhs. A factor is prepared to buy, look into this language, a factor is prepared to buy the firm's receivables by charging 2% commission. The factor will pay advance on the receivables to the firm at an interest rate of 18% per annum after withholding 10% as reserve. Calculate the effective cost of factoring to the firm. So friends, one important thing to be noticed over here is because the factor is prepared to buy the firm's receivable, that means all risk and rewards attached with the receivables will be bought by the factor, will be transferred to the factor. That means this is indirectly conveying a message that the factoring is on a non-recourse basis. Let us see how to present the solution. This time the question is silent about whether the collection will be made upfront or not. When the question is completely silent, my suggestion is always assume upfront collection of interest and fees. That is the general style. Okay, so generally the fees and interest is collected upfront. So first thing what we did is we have computed the average balance of debtors. From that you subtract the reserve of 10%, and what you get is amount eligible for advance, that is 72 lakhs. Then because you are assuming that the factor fees and interest will be collected upfront, so subtract the factor fees, and what you get is the amount on which interest will be charged, that is 70 lakh 40,000, and then compute the amount of interest for that one cycle, that will be 90 by 360 days. Notice one more thing, we are considering 360 days in a year. It is yet another assumption of ours. If you would want, you may take 365 days also, but as a general practice, whenever the credit period is given in number of days and it is a factor of 360, that is say 90 days, 30 days, 60 days, 120 days, we generally tend to take 360 days in a year. So the net amount advanced comes to 67,23,200. So friends, you may pause the video, note down the calculations, and if you have already done, let us move ahead. So the next obvious calculation is cost of factoring for the year, and this will be done in the usual way as you have been doing earlier. So factor fees will be 2% of total annual credit sales, that will be 2% of 3 crore 20 lakhs, that comes to 6 lakh 40,000. Interest charged by factor is 18% of 70 lakh 40,000, that is 12 lakh 67,200. Friends, understand one thing, this is the calculation made for the entire year. Earlier what we subtracted was on a per cycle basis. I have already explained you when should you make per cycle calculation and when should you use the annual calculations. So with this, the total cost comes to 19 lakh 7,200, and you subtract the savings in bad debts, and you also subtract the savings in administration and collection cost, and what you get is the net annual cost of 9,27,400. So annual effective cost of factoring would be 9,27,400 divided by the net amount advanced, that is rupees 67,23,200, and your effective cost of factoring finally comes to 13.79% per annum. So just take note of this whole thing, and that will be end of the solution.